All right, let's get to our closing bell exchange for this Thursday with the Dow down 29 points as we wait for tomorrow's jobs number. Ken Mahoney from Mahoney Asset Management is with us here at the big board. He's right next to Peter Costa from Empire Executions, and we've got Rick Santelli in Chicago. Peter Costa, is that what the market's waiting for? You know, we've had a couple of quiet days here after very strong days Monday and Tuesday. What's the catalyst right now?
Right now, the catalyst is going to be tomorrow. I mean, you know, everybody's been waiting to find out what the numbers are going to be like, how the Fed is going to respond to that, you know, over the coming month or so.
Everybody keeps raising their expectations now. Goldman went to 190,000 today from a previous 175,000 with some of the other data that's been coming out recently. So our expectations for that number are rising.
Yeah, there's expectations for everything is rising, you know, for tomorrow's numbers. And I think that is definitely going to, you know, it will spur the Fed. But they're also, you have to look at the Fed's looking long term. They're looking bigger picture. And I think that, you know, 1 month of very positive data, you know, some wage growth. I think it's more important that they get wage growth. If there's an acceleration in that, you know, then they may act. To me, I think it might be a little early. I think there's still, I still think that there's probably a couple more months of positive growth. You know, I've said this from the beginning of the year. I thought it would be next year. I thought it would be the first quarter of next year. I still stick with that.
Well, Ken, in the meantime, the market is separating the haves from the have-nots. If Facebook now joins Apple, Amazon, and Alphabet as those who have the formula, the winning formula today, who is in the have-not camp increasingly?
Well, definitely the haves are the fangs, as you mentioned. The have-nots are this past quarter. We see have-nots are IBM, Walmart, they missed. This morning we get to join the have-nots of Qualcomm and Whole Foods. And you're going to see a separation. We're seeing that already, like the haves and have-nots. As we get closer towards the end of the quarter, towards the end of this year, money managers are going to start dressing up their portfolios. You know, they're having this performance anxiety right now with the markets. They want to show that they own those fangs of Facebook, Amazon, Netflix, Google. They want to show they own those stocks as a top 10 holdings. They definitely want to show IBM and Walmart and some of those names.
Yeah.
Hey, Rick, I was having a little fun with charts this morning. We were all, you know, we're marveling at how the 2-year yield has gone to 4-year highs here. Maybe getting ready for a strong jobs number that might lead the Fed to raise rates by the end of the year. And I went back and looked at an even longer chart. This is a 20-year chart of the 2-year yield.
Yeah, you can't even find these yields. They just disappear, don't they?
Right. 8 years ago,
Absolutely.
the yield was 5%. 10 years ago, or 20 years ago, whatever it was was the yield on the 2-year note. I mean, fathom that, Rick.
Yep. It's automatic scaling, for one thing, that makes it so dramatic on computers. Listen, Bill, what you've arrived at is so telling. You know, how many times you hear people say raising a quarter point would be the end of the world, the system would come crashing? How did we survive? How do we have so much prosperity with close to double-digit interest rates? Yes. The trick is that when I read some of the things that Lockhart said, it makes me crazy. You know, they want to manage market expectations. Forget about that. Manage the economy. The market will follow. Listen, I'd like to ask everybody on our panel, if you look at year-to-date payroll creation, so far for the 9 months this year versus last year on an average, which year do you think is better?
Now.
Yeah,
anybody?
Right now. Up a tad.
Yeah.
Well,
now.
I will tell you that it's 25% less job creation on the 9 months this year, annualized, than it was last year. Last year was 260,000. This year, thus far, 197,000. So this notion of Janet Yellen saying, listen, everything's lining up, everything's changed so dramatically since the September meeting, I don't know. I'm data dependent. What data is she looking at?
I'll tell you, Rick, what makes me crazy. Why do we always talk about interest rates in nominal terms? If the interest rate is, you know, 4%, but you have growth doing and inflation doing one thing, that's a very different picture than if they're moving a different direction.
We don't have to worry about it. That's Mr. Market's job, okay? If investors are willing to take a yield of 224 for the 10s, it's all in the soup, okay? The soup's all done. The market mixes it all up for us.
Right, but what I'm saying is that 2%, while it doesn't look great on a historical basis, is probably, what, 3% if you throw inflation into it? That's not that dissimilar, right, from what that 3% real interest rate has been for 20, 30 years.
that would be you and I agreeing on what inflation is. And I absolutely don't agree that the personal consumption expenditure is any type of inflation indicator that I would put at the top of Mount Rushmore personally. I think the price of cheese, the price of milk, the price of lettuce or rent would be much better. Student, cost of college. You know, these numbers are always skewed to how much activity in your life. You only buy one house, you only send a kid to school for 4 years. But if those 4 years you send your kid to school for take 20 years of your savings away, maybe they need to weight this stuff a little more.
You know, it's really funny. You start looking at this. Is the Fed really data dependent? Or are they market dependent? It seems like in September they punted it because they're more
market dependent. Give that man a Cupid doll.
Yes, it's market dependent. But you know, we really have to get off this kind of bad news is good news for for the economy because we're not going to raise rates. You know, at some point we want to see job creation. We want to see the Fed normalize rates. You know, we can't stay at 0.25%. We have to give them some arrows in the quiver. We need to get Fed fund rates normalized to, I don't know, 2.5%. So there's something to work with.
All right, Peter, take us out. What levels are you watching right now? What's critical for this market at this point?
Well, there's two things. Number one, that historically over the last 33 years that I've been on the trading floor, on my birthday, the market has closed up above its previous close 85% of the time.
So happy birthday, Peter.
Thank you very much. So I wanted to bring that up as a little pat on my back.
That's pathetic.
No, you know, it's people are, I think that there's a lot of people staying on the sidelines. I think that they're a little nervous about what's going to happen tomorrow. You know, I mean, I don't think anything's going to happen tomorrow. I think what you're going to get is exactly what everyone's expecting.
Yep.
And then what we'll have to wait and see how the Fed perceives it. Is there, you know, there are any underlying numbers that are important in there that we really haven't looked at too much?
All right.
You know, I don't think there's going to be any surprises tomorrow.
A shameless fishing for a happy birthday.
Yes, absolutely.
Next, he's
absolutely. I will tell you that.
Check that.
Next, he's going to tell us he was 18 years old when he came onto the trading floor.
No, that I will not say.
Yeah, all right. Happy birthday, Peter.
Thank you.
Thanks, guys.
Everybody.